the key point is that the border adjustable tax taxes corporations on where their where their sales and purchases of goods occur, rather than on where they are headquartered or where they are producing the goods. And so because it doesn't tax people on where they're headquartered, there's no incentive for inversions. And because it's not taxing on production, there's no incentive to shift your production in order to shift your tax to a lower tax jurisdiction. And so it is a tax that is border adjusted. It is very hard to understand because its proponents in the Congress insist on describing it as if it were corporate income tax, but it's not like any corporate income tax in the world. I describe it in the slides as a cousin. I grew up in the South where everybody's a cousin, as a cousin to the value-added tax. It's more like a value-added tax for reasons I describe, with a deduction for wages. So it's also not like any value-added tax that exists anywhere in the world. And so what you have is a unique tax being proposed in lieu of the corporate income tax. And it is worth noting that the proposal in the form of the blueprint, which is the House Republicans' blueprint, a better way it's called, for tax reform, came out last summer at a time when even Paul Ryan and Kevin Brady and the House Republicans had not quite gotten to the point of believing that they would have a Republican House, a Republican Senate, and a Republican White House. They thought, as did all the pollsters at the time, that somebody else other than Donald Trump might be in the White House. And so it was put out as an idea, and it was supposed to germinate and be talked about and be thought about for years.
As it has been.
For years. The problem, of course, is that now they're going to introduce it as legislation within the next few months, and if the Secretary of the Treasury and others are to be believed, we want legislation by August. It's not it's a unique tax, doesn't exist anywhere in the world. It's got some value-added tax principles. The U.S. drafting staffs have no experience with value-added taxes and don't know how they work, and therefore, if you say, well, you should use the best practices on value-added taxes on this particular issue, they have to ask somebody, well, what are those best practices? Because we don't have a value-added tax. And it's also being sold in part like a corporate income tax, and it has some features, namely the taxation of investment income earned by corporations, which is an income tax, not a value-added tax idea and construct.
Here.
So can I just, I think one of the challenges about this plan is it's extremely complex. So I want to just try to reduce it to its essential parts so we all understand what it is, because I think there's a great deal of confusion about what it is. So there's the first piece, which is the rate comes down to 20%. The second piece is that all investment is expensed. So there's no more depreciation, there's no more deductions over time, you just expense everything that you buy. The third piece is you don't get to deduct interest anymore. These are very large changes to the current system. So 20% expensing of the investment, no interest deductibility, and then border adjustment. What does border adjustment mean? Exports are effectively tax-free, and imports are not deductible. So like think about the last time you traveled to a VAT country. If you have traveled to a VAT country, you know when you go get your refund at the thing in the airport, that's a border adjustment. Ours would work through the corporate sector. Why is this potentially a great thing? I want to give it its full due so we can see how it looks.
Pot of gold. We need to get to the pot of gold.
So why are we doing this potentially, right? It is a full takedown, I think, of the system. The first reason you would do this is if you're really worried about transfer pricing. There's no reason any longer to transfer price profits out of the U.S. because everything's done on what's called a destination basis. If anything, we will become a very large tax haven. People will be shipping profits into us. That's number one.
Asterisk, there's going to be a different kind of transfer pricing. But
it's a different kind of transfer pricing problem, but the one we've been worried about today,
right.
It goes away. Second,
Another asterisk. It goes away. It goes away for prices in and out of the U.S.,
Yes.
but it doesn't go away anywhere else in the world. And so if you've got global supply chains or anything else,
Yep.
and you hear transfer pricing goes away, it goes away
Right.
here.
Second reason to do this is you've effectively shifted to a consumption tax, which has been nirvana for many people for a long time. Why would you potentially want to do that? In part because the income tax is a taxation on consumption and savings. Effectively, by shifting to this base, you are exempting what's called the normal rate of return or savings returns from taxation. If you think that's important, this is a good way to do it without calling it a consumption tax or a value-added tax, because when you call something a value-added tax or consumption tax, it dies a quick death in Washington. So while it is in fact that, you get to not call it that. The third reason to do this is because now the effective rate of taxation on investment in the United States is going to be 0. And the reason for that is even if there's a 20% rate, on the margin, you will pay nothing because you are expensing all your investment, getting it as a deduction today. That's the promise of this bill.
This unique tax raises huge trade treaty problems. It violates, I'm going to say this as if it's true because it is true. It violates the WTO, even though a lot of people will tell you, well, it may not. Clearly, if a case goes to the WTO on this tax, the U.S. will lose. Don't bet. Don't put any money the other way. If you do, you'll never own your own home. It also raises major income tax treaty issues because we're not sure whether it's an income tax or whether it's not an income tax, and raises important issues relating to the BEPS project internationally. The partnership treatment itself may violate the WTO, putting aside the fact that the burden on imports is greater than the burden on domestic sales, which violates the national treatment requirement of the WTO. And this is the last thing I'll say. And we do not have, so I worked in the George Herbert Walker Bush administration at the Treasury. If this tax were enacted and George Herbert Walker Bush were the President of the United States, my assumption would have been, we'll work it out with the WTO, and if they don't work it out, we'll solve it with legislation. The current administration doesn't like multinational institutions, doesn't like multinational trade agreements. Donald Trump during the campaign called the WTO a disaster, and any number of his cabinet members in the current administration have talked about negotiating bilateral trade treaties. And he's talked about import duties and tariffs and the like. There are 163 other countries in the WTO, so you would have to engage in bilateral trade negotiations with many of them. I grant you don't have to have a trade treaty with all of them, but this is not a prospect that I think one should look on comfortably.
So what's problematic about this? I think Michael already started. I'm going to lay out a couple more things.
By all means.
But I did try to give it its full due. So the first thing, as Michael said, it's never been done before. But just on the economics of this, that will require pretty significant adjustments to prices of some kind. Why? Exports are now exempt and imports are being taxed. That will happen in one of two ways. There'll be a very large exchange rate movement. By very large, a 20% tax would result in a 25% appreciation of the dollar. Why is that? The short version is you have to run trade balances over time. You just made exports a lot more attractive than imports. Dollars got to move to offset that. That 25% revaluation of the dollar is huge. Think about dollar-denominated sovereign debt. Think about dollar-denominated emerging market debt. Think about the net foreign asset position of the United States citizens abroad, which would result in a $2 trillion loss, according to your slides. That's pretty massive. If it didn't happen through exchange rates, it would happen through prices. All the prices in the economy would have to adjust, and wages would have to adjust. That's really pretty disruptive on either way you think about this. The second piece is the part that are not known. And I'll just mention a couple that you didn't mention. They haven't really figured out financial institutions. which sounds like.
They
well,
haven't really figured out? They
haven't.
haven't started figuring out.
So the reason that's important is because financial institutions and financial services are embedded in all kinds of products, right? You get financing on a product, right? When you buy your Whirlpool, whatever it is that Whirlpool sells, machines, that is embedded financing. You need to strip that out if you really take this interest deductibility point seriously. That's really hard to do. And in general, they haven't figured out what a financial institution is or what to do with it. The second thing they haven't figured out is this pass-through piece. That causes a very obvious problem straight off the bat, which is pass-throughs are at 25%, businesses are getting taxed at 20%. Well, where are you going to put your deductions? Answer, you're going to put them in the pass-through entity.
Oh, it's worse than that, because wages are being taxed at 33 or 34 or 35%.
Absolutely.
And so where are you going to put your wages? You're going to put those in the partnership too. And you're going to put your deductions in the partnership and your income in the corporation. You're going to put your imports in the corporation and your exports in the partnership and so forth and so on.
I'll just mention the last piece of this, which is the political economy of this. When you exempt exports and you don't allow the deductibility of imports, the political economy, if you don't think about exchange rates or prices moving, is exporters will never pay taxes again at a first approximation. They'll be what is called in a structural NOL position. No taxes forever. Importers, think Best Buy, think Walmart, will not be able to deduct any of their imports, which is like all they do, is import from China and sell it to us. So
Meaning like they won't be able to deduct cost of goods.
They won't be able to basically deduct cost of goods sold. So there's massive redistribution across corporate sectors, which will in turn, unless exchange rates move like this, cause people to buy each other. So exporter Boeing will buy Walmart. Or alternatively, Boeing will use these pass-through entities to kind of get all kinds of things into this country.